Greetings and thank you for joining this webinar session. My name is Jim Ellert. Canadian by origin, I've been living in Europe for the last 40 years. Currently, I'm a visiting professor of finance and strategy at IEDC Bled School of Management and director of the school's MBA program. The topic for my session is the next recession. I will start with providing context and some history related to global economic recessions, and then compare USA and European responses and their effectiveness in managing the Great Recession of 2009. I will say something about the likely differences between the next recession and global recessions that we have already experienced. And I will brief you on the current global economic situation and sketch out how US and European policymakers are responding to the emerging 2020 crisis. I will comment on whether advanced economies can cope over long time periods with high levels of public government debt and close to zero interest rates. Finally, I will provide some thoughts and guidelines on how companies can navigate their way through the next global recession. Then there will be a Q&A opportunity for the audience. To prepare for the Q&A session, you can write your questions or comments by using the Q&A button at the end of your, at the bottom of your screen. These comments will then get accumulated and will serve as the basis for the Q&A session. Economists define a recession as two successive quarters economists will define a recession as two successive quarters, that is 6 months, of declining GDP. A country's gross domestic product, GDP, has three components: household consumption expenditures, business investments, and government spending. In times of recession, government spending is normally increased to offset, at least in part, declines in consumer spending and business investments. GDP is often defined in real terms, that is, after adjustments for inflation, and expressed in per capita terms, meaning per person in the country. Global recession is a recession that affects many countries simultaneously. The IMF, International Monetary Fund, defines a global recession as a decline in annual per capita real GDP backed up by a decline or worsening of one or more of 7 global economic health indicators, namely the level of industrial production, international trade flows, capital flows across countries, oil consumption, the unemployment rate, per capita business investment, and per capita consumption. According to this definition, since World War II, there have been only 4 global recessions: in 1975, 1982, 1991, and 2009. The 2009 global recession was by far the worst of the 4 post-war recessions, both in terms of the number of countries affected and the decline in real world GDP per capita. The good news is that none of these 4 recessions lasted longer than 1 year at the global level before the global economy started a recovery period. Deep recessions are often accompanied by prior accumulation of excessive levels of debt. In the low interest rate environment of the past decade, global debt levels have increased dramatically. Public debt, meaning government debt, has increased by more than 100% during this time period, mainly in the advanced economies of the United States, Western Europe, and Japan. Globally, non-financial sector corporate debt has increased by even more than public debt and is now higher than total global public debt. The growth in this category has been highest for Chinese and emerging market borrowers and is heavily weighted in the group of corporate bond issues that have low credit ratings. Global household debt, mainly home loans, auto loans, credit card loans, student loans, have increased by 25% over the last decade. So from a debt perspective, the global community is not well prepared for another global recession. Simply put, we have too much debt and not enough savings. In times of economic and financial crises, swift and decisive policy measures can speed up recovery and limit the damage associated with these crises. Let me illustrate by comparing public policy response patterns in the USA and Europe to resolve the 2009 crisis. In the USA, the government committed quickly, very quickly, to a $700 billion bailout package shortly after the collapse of Lehman Brothers, a large US investment bank. The size of the government bailout was designed to be large enough to be one time only, and in the end, only $440 billion of this money was actually dispersed. It consisted mainly of purchases of toxic bank financial assets, equity capital injections into US financial institutions, and limited support to the automobile manufacturers, General Motors and Chrysler. The central bank committed to unlimited support to provide liquidity for the banking and business sectors. Aside from increases in unemployment benefits, there was no significant direct relief for families or small businesses. The US government did not nationalize any financial institutions. Was this approach effective? By 2009, the US government is very close to being fully repaid for the loans it extended to the banks and made a small profit on the resale of its equity purchases when stock prices improved. So the bailout did not permanently increase the level of US government debt. The unemployment rate was reduced from a peak of 9.6% in year 2010 to 3.7% in year 2019, the lowest unemployment rate in the USA for several decades. Real GDP growth was restored from minus 2.5% in 2009 to plus 2.9% in 2015. Europe took a different path. Some countries nationalized hard-hit banks, which turned out not to be a good long-term investment for their citizens. It was not until 2012 that the European Central Bank committed to unlimited government bond purchases to reduce interest rates for hard-hit sovereign country borrowers like Greece, Italy, Spain, and Portugal. Following advice from the International Monetary Fund and with strong support from Germany, EU rules limited government spending in favor of austerity measures that in turn limited expansion of government spending to provide more direct relief to households and businesses. The austerity approach did not work. The unemployment in the euro area was 8% in 2019, with exceptionally high youth unemployment rates. Euro area real GDP growth rates averaged at an anemic 0.9% annually between 2009 and 2019. The 2020 global recession will have characteristics that are different from what we experienced in 2009. This will be the first global recession that is led by declines in service sector activity rather than by declines in industrial or manufacturing activity. This recession will not be led by a banking crisis. While not very profitable today, banks have safer balance sheets than in 2009 and will receive adequate monetary and fiscal support for survival. In 2009, the realization that we had entered a major banking crisis, particularly in the United States and Western Europe, led to a collapse of global stock prices. In 2020, the fear of an impending global recession is driving stock prices down. It is the case that global stock prices have been very volatile over the last 3 weeks, with average global stock price declines now in the range of 25% relative to early 2020 peaks. These price declines are still well below the declines of 50% that were more characteristic of former severe financial crises, suggesting that financial markets are currently pricing for a pure economic recession rather than a global financial crisis. Where are we today? Thursday, a week ago, the UK-based Economist Intelligence Unit, EIU, provided revised forecasts for real GDP growth rates for the full year 2020. The EIU has revised its forecast of global real GDP growth from +2% annual growth, its forecast in January, to -2.2%, the current forecast. These new forecasts paint a difficult picture ahead of us. Full year GDP growth is forecasted at -2.3% for the United States. The full year forecasts for large Eurozone countries are typically in the range of 5% negative GDP growth, with Germany and Italy at the high end, with negative GDP growth rate forecasts of about -7% by year end. China is expected to show positive 1% growth, significantly below the January initial forecast of close to 6% growth. It's expected that Latin American countries will experience more severe recessions than other emerging market countries. The EIU forecasts are based on the assumptions that the global COVID-19 virus will be contained and reversed over the next 2 to 3 months. The social lockdowns and travel restrictions will be lifted also, within the next 2 or 3 months, and that return to normal work practices will be followed by a relatively quick economic recovery in the second half of this year. The downside risks to the EIU baseline scenario are extremely high, however, as the emergence of second or third waves of the COVID-19 pandemic would sink GDP growth rates even further. Early statistics released this week from the US and European labor markets suggest that the number of people no longer in their regular employment has risen to about 10% of the workforce in a single 2-week period, an increase that is as large as what took place between 2007 and 2009. In the United States, the number of new workers seeking or making applications for social insurance has increased by close to 10 million workers over the last 2 weeks. The Financial Times noted earlier this week that unemployment is growing much faster than in previous recessions, and that social distancing measures are felt most severely in low-wage, labor-intensive sectors of the economy, such as retail, hospitality, and other consumer-facing industries. These are also sectors of the economy in which there are many small businesses ill-equipped to survive a sudden cash flow hit, and with large numbers of people in informal or more precarious forms of employment. In the United States, there has been a surge in redundancies, layoffs of workers with no guarantee of reemployment. In Europe, most workers affected have been laid off temporarily, but should have a job to return to, with the state supporting part of their wages in the meantime. The Danish government is leading the way here, paying 75% of employee salaries for private companies that have been negatively impacted by the pandemic. Countries will now rely on monetary and fiscal stimulus to combat the 2020 recession. Monetary policy will focus on providing liquidity to the financial system while maintaining a zero interest rate borrowing environment. In a business context, liquidity refers to the availability of cash or cash equivalents to meet operating expenses. Fiscal policy will rely on expanding government spending and/or reducing taxes to offset reductions in consumer spending and business investments. To illustrate how these policies are likely to play out, I will sketch for you the rescue plans legislated last week for the United States and Germany. In the US, the central bank, as in Europe, has limited scope to reduce interest further than 0%, but has committed to unlimited injection of cash into the financial system, whatever it takes to prevent a financial or liquidity crisis. The US Central Bank, by law, cannot lend money to ailing companies, but will provide a loan of close to $500 billion US dollars to the US government to make loans to troubled companies, including significant loans to small businesses that may be forgiven if these companies use the loans to keep workers on their payroll. The total US government rescue plan will cost about $2 trillion. Unlike the bailout plan of 2009, roughly 50% of this budget is designed to support business, and 50% will be used to support individual households, state and local governments, and to provide aid to hospitals. Direct support to families will include significant cash payments to most U.S. households and increase in unemployment insurance payments. To now, only the airline industry has been targeted for special treatment with an allocation of US dollars 50 billion in financial relief. It is the government's hope that this budget, representing about 10% of US GDP, will be enough to shore up the US economy for 2 or 3 months extension of the COVID-19 pandemic. Many observers, however, think that this rescue plan is too small and anticipate a second round of US fiscal stimulus over the next few months. In Germany, let's come back to 2 trillion US dollars. This is a very large number, and I'm sometimes asked how to conceptualize even 1 trillion US dollars. The simple answer is that 1 million is the number 1 followed by 6 zeros. 1 billion is the number 1 followed by 9 zeros. And 1 trillion is the number followed by 12 zeros. But most of us have difficulty internally conceptualizing numbers of this magnitude. Ask how to comprehend a trillion US dollars. Former US President Ronald Reagan provided the following explanation. If you stack crisp, freshly minted $1,000 banknotes, you will need 3 inches, or 7.7 centimeters, to account for 1 million US dollars. For 1 trillion US dollars, your stack will reach 34 miles, or close to 55 kilometers. So 1 trillion is a very, very big number. In Germany, its huge manufacturing sector is highly export-oriented, which means that the country is particularly exposed to both supply chain disruption and weak global demand. Last week, German legislators declared a state of emergency, abandoned the country's long-standing balanced budget policy, set aside constitutional public debt limitations, and unveiled a historic rescue package aimed at cushioning the impact of the COVID-19 crisis. The German rescue package has similarities with the US package, including higher social spending, business loans and loan guarantees, and potential equity investments or nationalization of some key distressed companies. The rescue plan will amount to 750 billion euros, a little above 20% of GDP, which is much higher than the US rescue plan of 10% of GDP. The German plan, however, is more highly weighted toward business support, 75% of the budget, than social support, 25%. However, the social support component of the budget represents 5% of GDP, very similar to the US plan. A few other European governments have already announced significant rescue plans. UK at 17% of GDP, Spain at 16%, and Denmark at 13% of GDP. Italy and France, with higher existing ratios of public debt to GDP, have announced much smaller rescue plans, about 2% of GDP only in both cases. On Wednesday of this week, the European Commission proposed a €100 billion plan to help the hardest hit governments to pay companies to keep workers in jobs. The plan would take the form of a lending scheme, but would need to be underpinned by guarantees from EU member countries. So the tables have turned since 2009, with those Western Europe countries that have relatively low ratios of public debt to GDP being more decisive in the magnitude of their rescue plans compared to the USA. Let me elaborate a bit further on the historical concerns related to rising levels of public debt as a percent of GDP. Several respected economists, most notably Carmen Reinhardt and Kenneth Rogoff, have argued that public debt to GDP ratios above 80% are not sustainable. First, they argue that ratios above this level typically result in bond rating downgrades for sovereign borrowers, leading to higher interest rates. And secondly, interest rate expense becomes too large as a percentage of total government expenditures to be sustainable. It should be noted, however, that most of the empirical research leading to these conclusions is based on the experience of emerging market countries that borrowed money at relatively high interest rates and in foreign currencies, mostly US dollars. Nevertheless, this line of argumentation was imported to Europe during the 2009 recession and led Germany in particular to insist on government austerity measures to prevent further increases in the ratios of public debt to GDP within the euro area. Can advanced economies cope over long time periods with high levels of public government debt and close to zero interest rates? Japan's experience suggests yes. To maintain social benefits, particularly for an aging population, Japan has printed money to support the highest global ratio of public debt to GDP in 2019 at 238%. Much higher than Greece, 177%, Italy, 133%, and USA at 106%. For the most part, since its major domestic financial crisis in 1992, Japanese monetary policy has been designed to provide zero interest rates to cushion the interest rate expense of high levels of government spending. Japan today is not a bankrupt country. It is true that its GDP growth rates since 1992 have been low compared with its Asian neighbors. But growth has still been positive, on average, over the last 3 decades for the Japanese economy. What do all of these developments mean for business decision-making in our region? Preservation of liquidity should be top of mind, and more so for small and medium-sized businesses. While most governments will provide some support to meet wage payments, declines in sales revenues will lead to business losses and impaired liquidity, not enough cash in relative to cash out. As for fiscal policy relief, I think most governments and central banks will focus on providing liquidity relief for larger companies and those industries deemed to be strategic in the national interest. So, what will companies do to preserve or enhance liquidity? Many companies will delay further payments to their suppliers. However, an account payable on one company's balance sheet is an account receivable on the balance sheet of another company. Those companies who pay even later save on interest cost, but this cost is passed on to their suppliers who need to find financing for larger levels of accounts receivable that could also lose value if some of their customers go bankrupt. There is a redistribution of wealth between corporate buyers and sellers, but overall economic wealth creation is diminished in proportion to the degree of company bankruptcies that result from the economic recession. To preserve liquidity, many companies will defer non-essential investments and sell off non-essential assets, typically at a discount to initial purchase price adjusted for accumulated depreciation charges. On the income statements, individual companies will try to reduce discretionary expenses, perhaps creating more unemployment in the process. International growth expansions will be put on hold for many companies. Large cash-rich companies will look for opportunities to acquire distressed competitors at bargain prices, meaning that we are likely to see further concentration of business ownership and a reduction in the numbers of small and medium-sized companies that have been critical drivers of GDP growth in recent decades. We will experience higher levels of uncertainty, at least until the COVID-19 crisis is resolved. Benchmarking business planning based on recessions learned from past recessions will not be enough. Smart companies will be developing more extreme downside and upside business scenarios and related contingency plans to allow agility and fast mover advantages depending on how the economic environment evolves. The emerging global recession is also likely to intensify social discussions related to the high levels of wealth inequality associated with the distribution of global wealth creation over the last few decades. Recently, in the United States, the bottom 40% of Americans own less than 1% of the country's wealth. The top 20% owned 80%, and the top 1% owned 39% of this wealth. Similar patterns have been identified by the French economist Thomas Piketty in several European countries, also in China, Russia, and many emerging market countries. Over the last decade, real wages for workers have been stagnant or declining in the United States. Some business leaders are beginning to recognize a social problem. Let me share two quotes from 2019 on this topic. The first quote comes from Jamie Dimon, Chairman and CEO of JP Morgan Chase, the most successful large bank in the United States, who says, and I quote, "The American dream is alive, but it's unraveling." And from US billionaire investor Ray Dalio, "Everything must evolve or die. This is now true for capitalism." Let me try to summarize this presentation. It seems inevitable now that we will experience a global recession this year. The duration and severity of the recession will depend mainly on the duration and severity of the COVID-19 pandemic. If the virus can be contained and resolved over the next 2 or 3 months, we could anticipate a very quick economic recovery over the second half of this year. Due to excessive debt accumulation over the last decade, all major sectors of the in all major sectors of the global debt market, the global community is not well prepared to combat yet another global economic recession. Resolving the next global recession will require unconditional monetary support to provide needed liquidity to the financial and business systems. Fiscal policy will need to be swift, decisive, and of larger magnitude than in any of the 4 other global recessions that we have experienced since 1971. This is no time to talk about fiscal policy austerity measures. Companies have limited options to preserve or enhance liquidity, and we can expect some further consolidation of industry ownership. Smart companies will engage in developing more extreme scenarios and related contingency plans. The next few weeks will be challenging, but I remain confident personally that we have the policy tools and the collective will to manage this recession decisively and swiftly until the COVID-19 virus is finally contained. After this happens, I anticipate a relatively fast global economic recovery. I thank you for listening to this talk and invite you to participate now in a Q&A session where you can share comments, alternative views, and/or ask questions. At the bottom of your screen, you will find a Q&A button that will allow you to enter type questions and comments. Okay, this comment is coming from Mariana Dimich-Perko, who says, "The stimulus packages around the world are enormous, but needed. This money coming from new issued money by central banks when they are buying government debt, that would mean we can expect inflation all over the world. Are there any calculations on that?" Let me respond initially to the first part of this question. The only thing that I can say is that we have been printing money in large amounts globally over the last decade. Surprisingly, we have not experienced inflation. I gave you the example of Japan, who has a history of 3 decades of printing excessive levels of money. We still haven't had recession. I don't understand why this has happened, but it's a fact. Second part of the question, stimulus loans to overcome first consequences of COVID could be at close to 0 interest rates. But can we expect a rise of interest rates for regular loans later? The answer to this is a little bit linked to the inflation question. Until the global economy is more or less fully restored to prior levels, let's say a few years, I do not anticipate a departure from zero interest rates. If we experience high levels of inflation, then interest rates could rise, but my expectation is that under such a circumstance, the central banks would put on the brakes, much like we did in the global economic crisis of 1981, which was associated with very high rates of inflation. In that context, the central bank began to contract the money supply, and both inflation and interest rates were brought down, but at the expense of another recession. Forgive me if I don't pronounce names right. However, this message is coming from Sladanya Imamovich, who says, were we heading to a great recession even without the COVID-19 crisis? My answer is that with the accumulation of debt in government, business, and household sectors that I mentioned earlier on, I think we would have had a recession in any event. The question was, when would this recession come? This question is coming from Milica Popovic. Some analysts compare the upcoming recession with post-World War II recession. But is it really that serious, given that nothing is really out of order, just temporarily frozen? Is it realistic to say that only or dominantly tourism and airline traffic will be hit significantly, while all other sectors will do reasonably well immediately after the pandemic is over? This observation does mirror the consensus viewpoint. Again, this is the first recession that we have had, first major recession that has been led by a decline of activity in the service levels or the service activities. Once we all get back to work, we should expect a faster recovery. Tourism, particularly in Croatia, may need additional government support to move back quickly to its former base. Airline traffic will be hit significantly, but most governments are earmarking funds to keep this industry alive. And again, once we start traveling again, we should expect an uptick in airline traffic. Liquidity again. Will the world economy be redefined post-pandemic in more national tone? Shall we now begin to less rely on China and other global supply chains and more to produce ourselves, at least when it comes to certain products which turn to be essential and high demand and in high demand during crisis? In terms of supply chain disruptions, we anticipate now that China is pretty much back to close to 60% industrial production levels. So within a few months, the supply chains from China should be relieved. On the other hand, the trade war between China and the United States could easily over time reduce the volume of trade flows between countries. I find this unfortunate because I do believe that strong levels of trade are in the best social good. What industries will see higher demand and growth opportunities in this context? My answer here, I think, is that there are relatively few particular industries that are going to benefit from the current situation. What do you think about this, Kamlev Fetchior? What do you think about this massive work from home shift actually happening? I don't think many of us appreciate the opportunity to be in isolation. At the same time, I think that this form of isolation will be critical in stemming the virus that we're currently dealing with. Interesting question. Vedad Silyak. In each recession, there were losers, many of them, and winners, relatively few of them. Or to say, those who lost less than the others. My question is, who are going to be the winners of the upcoming global recession, both by country and industry? I don't see a lot of winners coming out of this crisis. I think it's fair to say that emerging economies will be hit harder than the average. I think it will also be the case that Western Europe will be hit harder than other countries. Industries is a tough one to be able to respond to. Okay, as we have many questions, I'm going to skip names and simply indicate the question. Is education, including IEDC, moving massively online? I think the answer here is that this crisis will have a fundamental and long-standing impact on education, particularly with the development in the future of more online learning as we gain experience with this medium. Maybe some pointers and personal suggestions for portfolio rebalancing and individual investments at this time. For the most part, I think we should stick individually with the long-term asset allocations that have served us quite well over time. In the short term, if the pandemic worsens, one could expect further declines in stock prices, possibly increases in the price of gold, and possibly benefits from investing in real estate funds. Kind of a related question, do you think stock markets are close to the bottom? The answer again depends on the uncertainty related to the severity and the duration of COVID-19. If it turns out to be the case that we can defeat this virus over the next 2 to 3 months, then my estimation would be that stock prices are probably fairly valued at this point in time. If it turns out that the crisis is much longer in duration, then we would have the possibility of stock prices falling even further than the 50% bottoms that we saw in prior crises. Some of the questions that I'm scrolling through are similar to ones that I've already responded to. Another market question. Do you think many companies will stop paying dividend payments in 2020? Would that trigger another sell-off on the stock market? The experience from the 2019 crisis was that many companies did decrease their dividend payouts in 2009. This reaction was generally not favorably accepted by the stock markets, with the stock prices of companies maintaining or increasing their dividend payouts performing much better than companies that decreased their dividend payments to provide cash. Okay, what would be new normal in business, according to your opinion, after COVID-19 would be contained? At least in the Western world, I think we're probably looking at a decade, at least maybe 2 decades of lower than normal historic GDP growth rates. The historic Western GDP growth rate has been about 3%. I think the new norm will be closer to 2%. Okay, what do you expect will happen to the euro as a currency value? Tough question, and we get kind of speculative here. With the US bringing its interest rates down to 0, I would expect a weakening of the US dollar relative to the euro, at least over the duration of this particular recession. Do you think it's time for IMF to change recession indicators? For example, the use of oil that you mentioned. In line with environmental needs, oil has to go anyway and give way to clean energy. Part of the crisis that we're in right now has been deepened by the coincidence of the COVID virus, at the same time as we're experiencing a war between Saudi Arabia and Russia in terms of the oil market. The declines in oil prices have contributed quite heavily to the uncertainty in the stock markets during the first part of this year. With respect to other changes, I think the IMF should be moving away from a single indicator of industrial output to an indicator that also takes into account service sector activities. What is your opinion of the impact of the current situation on mutual fund strategies? Mutual funds have grown as an outlet for investor funds quite significantly over the last 2 decades. Part of the price that we pay today is that when we move into times of crisis, small investors in particular tend to take their money out of mutual funds, which in turn means that these funds have to sell other assets to provide the return of money to these investors. And these forced sales have certainly contributed to the decline in stock prices globally over the last few months. How do you think the fundamentals of capitalism and inequality will change in future years? Interesting question. My own view, I think I share the views of that I expressed earlier with Ray Dalio and Jamie Dimon. Capitalism at the moment, in some respects, particularly wealth inequality, is broken and tarnished. How do we get around this? I think what we will need in the future is more fiscal policy, taxation mainly, designed to redistribute wealth away from the few and to funnel those monies into providing benefits for the broader community. Is there a possible trend that business travel would decline as companies find out during crisis that they can do a lot of meetings online? I agree with this comment. I think we're learning to work better online. We will gain experience. And my expectation also is that even if we get a fast resolution to the crisis, some business people and companies will not want to see as much business travel. Okay, there are many more questions that have been sent to me, but I think now we're running out of time. I'm getting a little bit exhausted. So I'm going to close this session off at this point in time. Some of the messages I have are from people that I know already, and I will try to find a way to contact some of these individuals by email. So, thank you very much for spending this hour with me. I hope it was useful for you, and keep well, all of us, as we see ourselves through the next few weeks. Closing off, Jim.